What's up, Warren's Money Buffet family? Today we're tackling one of the most expensive mistakes I see investors make over and over again. And here's the kicker. It feels so logical that even smart people fall for it. Picture this. You've got $1,000 to invest. Option A is Eli Lilly at $760 per share. You can only buy 1.3 shares. Option B is Ford at $10.85 per share. You can buy 92 whole shares. Most people think 92 shares sounds way better than one share, right? Wrong. Dead wrong. And this thinking is costing investors millions. I'm seeing the same psychology play out in crypto too. People bypass Bitcoin at $118,000 per coin to buy XRP at $3.24 because they think they're getting a better deal. Today, I'm going to show you why this is one of the most dangerous traps in investing. Let's get into the psychology here, because understanding why our brains trick us is the first step to avoiding this costly error. This bias has a name. It's called nominal price illusion, or the lottery effect. Research shows that investors systematically overestimate the growth potential of low-priced stocks simply because the share price looks cheaper. Here's what happens to your brain. You see Ford at $10 and think this could easily go to $20. That's only a $10 increase. But you see Eli Lilly at $760 a share and think, how could this possibly double to $1,500? That's a $760 increase. But here's the thing. What matters isn't the dollar increase, it's the percentage increase. If Ford goes from $10 to $20, that's a 100% gain. If Eli Lilly goes from $760 to $1,520, that's also a 100% gain. Your $1,000 investment doubles in both cases. This is the same psychology that makes people buy lottery tickets. You're not thinking about probability or actual value. You're thinking about the fantasy of owning lots of shares or getting that massive multiplier. Market cap, the real measure of value. All right, let's talk about what actually matters. Market capitalization. This is where most investors completely miss the boat. Market cap is simple. Share price times total share outstanding. Eli Lilly's market cap is $721 billion, while Ford's is only $42 billion. Based on current data. That means Eli Lilly, despite its higher share price, is actually 17 times more valuable than Ford as a company. Think of it like this. Would you rather own 1% of a $100 million company or 10% of a $5 million company? Obviously, the 1% stake is worth twice as much, $1 million versus $500,000, even though you own a smaller percentage. But investors get fooled by the share count. They think, I own 92 shares of Ford, but only one share of Eli Lilly, so Ford must be the better deal. That's like saying a dime is worth more than a quarter because 10 is bigger than 25. The brutal truth, when you focus on share price instead of market cap, you're essentially saying you don't understand what you're buying. The crypto parallel, XRP versus Bitcoin. This same mistake is absolutely rampant in cryptocurrency, and I see it every single day. People look at Bitcoin at $118,000 per coin and XRP at $3 a coin and think XRP is the better value. I constantly hear XRP is cheap. It could go to Bitcoin's price someday. Let me shatter this illusion right now. Bitcoin's market cap is $2.36 trillion. XRP's market cap is $192 billion. For XRP to match Bitcoin's market cap, it would need to hit about $40 per coin, not $118,000. That's because there are 59 billion XRP coins versus only 21 million Bit. Here's the math that'll blow your mind. For XRP to reach Bitcoin's current price of 118,000, XRP's market cap would need to hit $7 quadrillion. That's more than the entire global economy by about 100 times over. Yet people keep buying XRP thinking it's cheaper than Bitcoin. This is the lottery mentality in action. They want to own thousands of coins instead of fractions of Bitcoin, even though Bitcoin has far superior fundamentals. Real examples when share price fools investors. Let me give you some concrete examples of how this thinking destroys returns. Penny stocks are the ultimate example of this bias. Investors gravitate towards stocks under $5 because they can buy hundreds of thousands of shares. But research shows that penny stocks as a group massively underperform the market. One study found that stocks trading below $5 underperform stocks above $5 by 8.6 percentage points annually. The high volatility and poor returns resulted in a Sharpe ratio of -2.06 versus 0.61 for higher priced stocks. Why do people keep buying them? The lottery effect. Investors accept the high likelihood of poor results in exchange for the small chance of hitting it big. It's gambling disguised as investing. Stock splits provide another perfect example. When a company splits its stock 2-for-1, taking the price from 100 to 50, many investors think they're getting a better deal, but nothing has changed. You own twice as many shares worth half as much of each. Yet research shows that split announcements often cause temporary price increases because investors suffer from this nominal price illusion. The mathematics of percentage returns. Let me drive this home with simple math that every investor needs to understand. Let's say you invest $1,000 each in Eli Lilly at $760 per share and Ford at $10.85 per share. You get 1.3 shares of Eli Lilly and 92 shares of Ford. Now both stocks go up 20%. Eli Lilly goes to $912, Ford goes to $13. Your Eli Lilly investment is worth $1,200. Your Ford investment is also worth $1,200. Same percentage gain, same dollar amount, same percentage gain, same dollar return on your investment. The number of shares you own is completely irrelevant. But here's what trips people up. Eli Lilly went up $152 per share. Ford only went up $2.17 per share. People think, wow, Eli Lilly gained so much more, but that's only because Eli Lilly started at a higher price. What matters is that both investments return 20% of your money, period. How to avoid this costly mistake. So how do you avoid falling into this trap? First, completely ignore share price when evaluating investments. When evaluating investments, focus on market cap, fundamentals, and business quality. Second, think in percentages, not dollar amounts. If you expect a stock to double, it doesn't matter if it goes from 5 to 10 or 500 to 1,000. You make the same return. Third, understand that owning more shares doesn't make you richer. Owning 1,000 shares of a terrible company is worse than owning 1 share of an excellent company. Finally, remember that investing cheap doesn't mean low share price. It means trading below intrinsic value relative to the business fundamentals. In closing, look, I get it. Our brains are wired to think that more shares equals better value, but successful investing requires overcoming these psychological biases. The investors making real money focus on business quality, growth prospects, and valuation metrics, not share count. They buy great companies regardless of whether they can afford 1 share or 1,000 shares. Don't let nominal price illusion rob you of real returns. Whether it's avoiding Eli Lilly because it's expensive at $760 or chasing XRP because it's cheap at $3. If this video opened your eyes to a mistake you've been making, smash that like button and subscribe for more investing reality checks. Drop a comment and tell me, have you ever avoided a great stock just because the share price seemed too high? Remember, it's not about how many shares you own, it's about the percentage of your money that grows. Everyone stay smart, and I'll see you in the next video. Thanks for watching.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.